Hi, in this video we're going to be looking at one of the key sources of risks that we'll find in financial assets, and this is interest rate risk. So to begin with, what is interest rate risk? Well, this is where investments may make losses due to a change in interest rates. This is obviously a key risk that investors are worried about, where their investments say decrease in value and they make losses. And well, we tend to be uncertain about what interest rates are going to be doing in the future, which is what makes it uncertain. What makes it a risk is that interest rates may change. So interest rate changes can affect almost all investments in some way or another, but they increase the value of fixed income securities most directly. And the key example of this that we're going to be looking at is going to be bonds. So what is a fixed income security? Well, it's sort of in the name, but it's a type of investment that offers fixed interest payments. So our example here is just that we have some sort of investment which pays 5% interest, and this 5% value is going to be fixed. Say each year we earn 5% interest on our investment, and this doesn't change based on some other value that may change over time. It's going to be fixed at 5%. And our key example is going to be bonds. And so we'll be looking at the bond market in a bit more detail here. So the thing with bond prices is that they move in the opposite direction of interest rates. So our two possible changes in interest rates: if interest rates were to rise, bond prices are going to fall. And this is going to mean that the yields on our bonds will rise as well. And if interest rates fall, bond prices are going to rise and yields will fall. So this is a key relationship to remember, that bond yields sort of respond as a one-to-one correspondence, or not necessarily one-to-one, but they are correlated positively with interest rate changes, whereas bond prices will fall, and so they are correlated negatively with interest rates. So why is this? Well, if we're going to have an increase in our interest rates, and we've seen that, say, in the UK very recently with the base rate being increased by the Monetary Policy Committee, then the opportunity cost of holding bonds will also increase. What does this mean? Well, there are higher returns elsewhere because the interest rate has risen, so you're going to be missing out on these if you hold bonds. So let's run through a quick example. Let's say that we have some bond, a government bond, which is paying a fixed interest rate of 2%. Let's also assume for the moment that our interest rate in our economy is the exact same thing at 2%. So we don't really mind whether we're holding a bond or an interest rate. They pay the same rate of interest wherever we hold our money. So this bond may be worth its par value, and we can have this value of the bond as being $1,000. And this is fine when the interest rate is 2%. However, let's consider that we have this scenario where our interest rate increases. And let's have our interest rate going up to 5% now. This bond that's paying 2% interest is going to be much less attractive. This is because, well, why would you buy a bond that pays 2% interest if you could earn this 5% interest rate elsewhere by just holding your money in a bank account or making some other investment? There is thus some disparity between the bond interest rate and the just general interest rate in our economy. The market thus has to compensate by decreasing the price of bonds. So this price of bonds is going to fall from this $1,000 value. So this is why we have this negative correlation between interest rates and bond prices. And as we say, this is why interest rates have such a direct impact on bond prices, because we have this very clear correlation. However, it isn't just fixed income securities that are affected by interest rate risk. Interest rates have a wide-reaching impact on an economy, and if you've studied economics, you will know that they increase the cost of borrowing, they incentivize saving, and as a knock-on consequence of these things, this may reduce consumer spending. That isn't even to mention the fact that interest rates have an impact on inflation and the exchange rate. So we can also see that stock prices may change due to a change in our interest rates. And if we just have a quick look at this, in the past we've seen that there's a correlation between stocks and bond prices. And this correlation used to be positive, but more recently this has generally been negative. But this relationship doesn't matter just as long as we acknowledge that there is some relationship here. So stock prices will be affected by changes in interest rates. And this is looking at stocks more generally, but as a matter of fact, different stocks will be affected differently by a change in interest rates. For example, a housing business will be affected very differently by a change in interest rates to a discount clothing store. It depends which stocks you're holding as to how these will be affected by interest rates, but most of them will be affected in some way for the reasons that we've just mentioned. So it is something to keep in mind for all types of financial assets, but that is a quick introduction to interest rate risk. If you found this video interesting, please do leave a like. Make sure to check out the channel for more videos like this one and subscribe to add some econ to your subscription feed.